March 1990, Brisbane, Queensland. Inside a glass office tower on the edge of the city, phones stop ringing. Estate Mortgage Managers Limited freezes redemptions on 6 investment trusts overnight. For almost 14 years, the company had told investors something simple. No one had ever lost a dollar in a public mortgage trust. Estate Mortgage had never lost principal on a single loan. That claim appeared in the firm's own literature just weeks before the collapse, printed under a photograph of Managing Director Reuben Lew. Thousands of small investors believed it. Retirees, farmers, widows living on fixed incomes. They had been promised steady returns, paid quarterly, backed by real Queensland property. It sounded safer than the stock market. It sounded safer than a bank. By the late 1980s, Estate Mortgage had grown into one of the largest mortgage trust groups in the country. Money poured in from small investors chasing yield because interest rates were high and bank deposits paid less than the trusts promised. The company lent that money out against property developments across Queensland. Shopping centers, apartment blocks, commercial towers rising along the coast during the property boom. On paper, the model was simple. Investors' capital went out as mortgages. Interest came back in as income. Everyone got paid. What investors could not see was what stood behind those loans. Many of the properties securing Estate Mortgage's lending were still under construction, still unsold, still dependent on a market that assumed prices would keep climbing. Some loans were made to related parties within the group's own corporate structure, which meant the trust was, in places, lending to itself. Because of this, the trusts carried far more risk than the marketing suggested. The company was managed by a father and son team. Reuben Lew served as consultant. His son Reuben Lew served as managing director. Together, they controlled the direction of 6 separate trusts and the loans made in their name. Then the market turned. Treasurer Paul Keating had raised interest rates sharply to slow an overheated economy in what he would later call the recession Australia had to have. Borrowing costs climbed past 17%. Property developers who had built on the assumption of easy refinancing suddenly could not refinance at all. Sales stalled. Settlements were delayed. Across the country, the commercial property market that had powered the 1980s boom began to seize. Estate Mortgage's loan book, tied so heavily to that market, began to fail with it. Developers missed interest payments. Some projects stalled halfway finished, steel frames standing empty against the skyline. The trusts kept crediting income to investors regardless. Income the underlying loans were no longer generating. What nobody outside the company understood was how far behind reality the numbers had already fallen. Warnings had reached regulators before the collapse. Greg Paramore, a senior figure in the managed funds industry and chair of the Unit Trust Association, had quietly flagged concerns about Estate Mortgage to the National Companies and Securities Commission. His warnings had little practical effect. The commission lacked the powers and perhaps the urgency to intervene before the trusts ran out of road. By March 1990, they had. Estate Mortgage Managers Limited failed. Income stopped being credited to the 6 trusts. Unit redemptions were frozen, which meant investors could not withdraw their own money even if they needed it for rent, for medication, for retirement. They had already begun. The company told unit holders they were likely to receive only a small percentage of their capital back. For many, that meant their retirement savings, built over decades, were reduced to a fraction of their original value almost overnight. Behind the trust stood a custodian, Burns Philp trustee, whose job was to safeguard investor assets independent of the manager. That safeguard failed too. Burns Philp trustee itself went into difficulty in the wake of the collapse, and investors were eventually able to recover only around $150,000 from the company's insurers, a figure that barely registered against total losses estimated at close to $500 million. In October 1990, Global Funds Management was appointed to take over administration of what remained of the trusts